Hi, my name is Aaron Rubin, and I'm your plan advisor. And today I'm going to talk to you about the events that were the first quarter of 2014. Now, 2013 was a pretty gosh darn good year, hard to beat. And unfortunately, the first quarter of 2014 didn't keep pace. Now, we had a really bad January, a pretty good February, and a lackluster March. But the market giveth and the market taketh away. Now, the other thing I want to talk to you about today is keeping up with inflation and why it's important to have stocks as part of your portfolio. So let's go ahead and dive right in. So, as I mentioned, stock market this quarter flat-ish. Obviously, we still have a lot of green arrows, which is always good. The one red arrow of note is emerging markets. Emerging markets have had some trouble, I'd say, the last almost a couple of years at this point. But again, it's one of those really volatile asset classes that sometimes it just outperforms the market like crazy and then sometimes underperforms. So over a long period of time, emerging markets brings a lot to the party, is a good diversifying type investment, and really belongs in a well-balanced, diversified portfolio. Now, the big winner for the quarter was the U.S. REITs. Again, a lot of people are very surprised when they see real estate do very well, but again, you never know which asset class is going to perform really well and which is going to underperform, which is why we're diversified across all asset classes. This quarter, even the bond funds up ever so slightly, which is good. Again, they are not meant to overperform the market. They're meant to bring stability to the portfolio, which is exactly what they're doing. So again, big winners, REITs and the small international. Losers, emerging markets, and the U.S. small. Again, it's good that they don't act together because that helps in providing overall market return with lowering volatility. And to nobody's surprise, the portfolios that we show you here are in line with what happened in the underlying asset classes. That is to say, the more stock that you had in your portfolio, the better off you did this quarter. And that's true for the 1-year, 5-year, and 10-year rolling numbers. Now, of course, there is a trade-off for this. That 10-year volatility shows you how much the portfolios bounced around during that 10-year period. So the higher the number, the more the volatility, the more bounce there was over the last 10-year period. And keep in mind, this also includes the 2008 crash as well as the 6th worst stock market in the U.S. In 2011 for that particular third quarter. Now, what's important to note here is that it's important that you are in the correct portfolio for you. And that even though we can look back and say, well, gosh, had we just been in stock the entire time over the 10 years, we would have been better off, which is true. The fact of the matter is that if you were to have bailed in 2008, 2009 while your stock market was losing 50% of its value, really you would have done yourself a much bigger disservice than being in a portfolio that reflected your risk tolerance. As we talk about standard deviation, risk, and diversification, we need to keep in mind what that really means. Now, diversification is not meant to guarantee any kind of gain. Completely the opposite. You're still subject to market risk. But when you diversify, both international and domestically, you're going to lower your volatility. Now that's important for help keeping you in the market as much as you can. So 50% of world capitalization, that is the value of companies worldwide, is located in the United States. The rest is located internationally. And what's important is that if you just invested in the U.S., if you just invested in the Russell 3000, you're missing out on half the picture, and you're missing out on half the returns that are being provided abroad. So again, in our portfolios, we need to make sure that we have all our bases covered because you never know which particular asset class is going to be the next one to do really well and which one's going to be the next one to fall on its face. But again, all we're trying to do is capture market return worldwide. The second thing I want to talk about is inflation. and how when we go to invest, we need to keep in mind that all of our money, no matter where it is eroding over time due to rising prices. So, let's start investigating. If we were planning for retirement in 1984, hoping for a 2014 retirement, what would our assumptions be? Well, we'd think a mortgage would be somewhere in the double digits. 14.5% was the prevailing rate at the time. A CD could probably get around 11%. The S&P was at 164, so we might think maybe the S&P in 30 years would be maybe 1,000. When we thought about our retirement and all the travels we were doing, we'd stock up on all of our film, which was always annoying to try to load in the back of the camera and risk exposure when we took it out. And of course, the personal computer had just become personal, but I don't think we'd be planning on having a fancy computer in our homes. And so let's get back to 2014. Remember, in 1984, we had planned for a 14.5% mortgage. Well, in reality, our mortgage is closer to 4.5%. Our CDs, there's no way we're getting 11% in the bank. If we get 1%, we should feel lucky. The S&P 500, well above the 1,000 that we probably would have thought. It's at 1,800 most of the time. And forget about film. You probably don't even have a camera anymore because you're using your smartphone. And of course, having a fancy computer in your house, dirt cheap. And not only that, you have your tablet too. So again, all the things we planned for 30 years ago no longer apply. What this is to say that you don't know what the future brings, and you can't really bank what you're going to need or what you're going to want in 30 years with what's going on right now. The only thing you can take to the bank is that things are going to be more expensive. So when we look in 1984 at the price of a movie ticket, average price was $3.36. Today, $8.35 is the average price, and if you live in California like I do, you know that it's probably more expensive than that if you're going to a nice theater. Represents an annual inflation of 3.1%. The gallon of gas that we complain so bitterly about having to buy averages $3.52 nationally. Again, California, it's even higher than that. A Big Mac, $1.50 in '84, $4.62 now. Cornflakes, under $1 in '84. You can't get gum for under $1 now. And that ticket to the Magic Kingdom is going to set you back a pretty penny as opposed to 1984. And what that means is that when we go to invest for our 401ks, for our IRAs, for anything, we need to keep in mind when we think about our risk tolerance and what we're going to need, that the things that we need and want in the future are going to cost a lot more, and we need to invest accordingly. So how do the different asset classes compare with inflation? We saw that second graph that I showed with the portfolios over 1 to 10 years. And what we see is since 1926, which is right before the Great Depression, we see that cash has returned 3.5%. If we adjust for an average rate of inflation, the cash in terms of real dollars is only giving you 0.5%. Bonds, 5.5% nominally. When we adjust the returns for inflation, 2.5%. Stocks, 9.9%. Adjusted for inflation, 6.7%. So what does this really mean? What this means is the only way to keep pace with inflation and actually grow your money is by having some portion, and sometimes a significant portion, in stocks. Now, of course, I'm not going to recommend anybody invest just in stocks or more in stocks until you've taken a hard look at your own risk tolerance. But the truth of the matter is that if you put all of your money in bonds or all of your money in cash, you're destined to not have enough for retirement and living in the lifestyle that you want to be able to. The problem that most people have with putting more in the stock market is that this perceived level of risk. And unfortunately, that perceived level of risk is actually a real level of risk. That you can lose a lot of money very quickly in the stock market. But it's important to understand that there's a trade-off involved. That if you're not willing to lose that money, you may not have the amount of money you want when you go to retire. So if we take a look at the worst nominal performance in bond market history, which is 2009. So you open your statement for your bond funds on January 1st, 2009, and you open it again in December 31st, 2009. What you found is your bond fund went down 15%, which stinks. But if you were to open up your stock fund in 1929, January 1st, 1929, and you were to open it again in December 31st of 1932, what you find is your portfolio of stocks went down 64%, which is a lot worse than 15%. And so you understand, you see those real numbers, and you say, oh my gosh, look how much money I lost. But if you adjust for the worst performing periods for inflation, what you'll find is from 1941 all the way to 1981, if you take inflation into account, bonds lost about 63% of their value. Whereas that worst period in stock market history, if you adjust it for inflation, lost about 54% of the value. Now that's still not a very fun number to think about, opening up and adjusting for inflation and finding you lost 54%. But what you find is, I'm trying to tell you, is that the bond fund can really, really crush you in terms of inflation adjustment. And so being in stock is very, very important. And even if you are a risk-averse person, some of it should be in stock. Again, you need to know what's right for you. And when we look at the ability to have an income stream in retirement, it's important to note that the more you're going to try to tax your portfolio in terms of rate of withdrawal, the more you're going to have to rely on stock market performance to get you there. So what I have in front of you here is the result of a Monte Carlo simulation, which is a simulation which runs 1,000 iterations of possible performances based upon historical rates of return and standard deviation. And what we find is that if you're only going to take 4% of your portfolio, almost no matter what you do, you have a pretty good shot of being able to live 25 years in retirement and not run out of money. Now, if we increase that just to 1%, so that we have a 5% rate of withdrawal, we can already tell that having 100% in bonds means we have a less than 50% chance of being able to make it through retirement without running out of money. And even if you add a little bit to the stock mix, only 25% stock, your chances of not running out of money goes up dramatically. Now, if you want to start taking out 6%, 7%, or even more, what you're going to find is that the more you have in bonds, the less likely it is you're going to be able to live a full retirement of what I say is 25 years and not run out of money. So part of your investing has to figure into that, is how much are you going to be withdrawing? If you're going to be withdrawing a lot, you're going to need to take a lot of risk. Again, as Harry Markowitz once said, there's no such thing as a free lunch. And when you have a significant amount in the market, it probably is going to make you very, very nervous. And more importantly, it's probably going to make you pay closer attention to the performance of the S&P. It's going to make you be more curious about watching shows on the stock market, trying to figure out if you're in the right place. And I think we'd be wise to heed the words of Warren Buffett. And what he says is, because there is so much chatter about markets, the economy, interest rates, price behavior of stock, etc., some investors believe it is important to listen to pundits, and worse yet, important to consider acting upon their comments. There is a lot that you cannot control. The stock market is one of those things you cannot control. So listening to pundits, listening to various opinions on the market is going to do you no good. The only thing that you can control is your portfolio and your exposure to risk. So, That was Q1. Now, keep in mind, past performance does not indicate future results, so we really have no idea what quarters 2, 3, and 4 are going to bring for us. So, the most important thing to do is be in the right portfolio for you. And as we discussed, be sure that you're taking into account inflation when you think about your risk level and where you're trying to be when you get to retirement. Best of success for the next quarter. Thanks.